Greetings and welcome to Keystone TV. I appreciate you checking out our video today. It shows that you care about your financial future and want to improve yourself. Today we're going to look at part 2 of our gold series. If you want to reference back to our archived videos, part 1 we discussed the myth that gold has provided tremendous performance or even good performance. It's just not the case. If you want to learn more about that, check out part 1 of our gold series. Today we're going to focus on 2 other myths related to gold. The first one is that gold serves as a great inflationary hedge in your portfolio, right? One of the things that people do is they especially in times of extreme market volatility with stocks like we've had, people start looking and searching for alternatives. And one of the things that maybe an advisor has told you or a friend has told you is that gold would be a great spot to put money in the event we get into an inflationary time period. But let's actually look at that from a historical perspective. If we go back to 1979 through 1984, it's one of the highest inflationary one of the highest times of inflation our country's encountered. In fact, it was the consumer price index rose by 7.5% per year over that time period. So what did gold do during that time period? It rose by a mere 3.7% per year. That's hardly an inflationary hedge. So that in and of itself is untrue. But let's look at one of the other reasons that people rush to gold, and that is to hedge against a weakening dollar. Now, a weak dollar occurs when our U.S. currency falls in value relative to, say, the euro or Japanese yen or British pound. And one of the things that many investors believe is that if they're in gold, that will hedge against that because it has an inverse correlation to the weakening dollar. But actually, it couldn't be further from the truth. Over the last 40 years, a weakening dollar has inversely reacted to gold prices only 20% of the time, meaning 80% of the time, a weakening dollar correlates with the movement of gold. So it's not in any way, shape, or form a good hedge against a weakening dollar. So let's recap the 3 biggest myths about gold going back to our previous video. It doesn't get good performance. It's not a good hedge against inflation. And it doesn't work inversely with a declining US dollar. So if you keep those 3 facts in mind, hopefully you'll be able to stay the course. And when you hear the countless gold commercials that are sure to come up, I mean, if you remember back to 2008 and 2009, you couldn't turn on your radio or TV without seeing gold commercials. So the next time you hear one, turn it off. If you're going to buy gold, buy it in the form of jewelry and wear it, but don't invest in it. Hope this is helpful. Thanks for joining me. Have a great day.